G'day guys, it's Nathan here. Navigating through the Aussie property market just got a little bit easier. Tune in as we delve into the South Australian Government's groundbreaking new reforms for first homeowners, and we're going to explore the changing landscape of the Australian real estate industry. The South Australian Government has put forward a major reform aimed at supporting first homeowners in the face of raising interest rates and competitive property market. Under the new plan, stamp duty would be abolished for first-time homeowners purchasing a property up to the value of $650,000. The initiative mirrors similar actions we've seen in New South Wales, where strategies are being deployed to boost housing affordability and invigorate supply as interest rates escalate. The State Treasurer has also warned that families have limited tolerance for additional interest rate increases from the Reserve Bank. With dozens of rate hikes we've seen in recent times, it's hoped that the elimination of stamp duty will provide much needed relief for those trying to enter into the property market for the first time. This measure is also anticipated to bolster the housing construction sector, which has seen a 20% reduction in home approvals in the most recent times. The exemption from stamp duty, which came into effect immediately, offers a potential savings of up to $29,000 for first homeowners purchasing up to a maximum price limit of $650,000. A scale also applies up to $700,000 after the exemptions cease. So for first homeowners, there's also grants available totaling $15,000, which makes the total sum of benefits available for first homeowners in South Australia up to $44,000. A similar scheme is also operating in New South Wales, where the threshold has been increased to $800,000. So lots of great benefits for first homeowners out there, both in New South Wales and South Australia. And the budget in South Australia anticipates more challenging times ahead in the South Australian economy, predicting a mere 1% growth in financial year 2023-2024. The budget also showed a deficit of $249 million in the 2022-2023 financial year, which is a stark contrast from the $233 million surplus they saw last year. However, it foresees a $250 million surplus in the financial year 24. While credit rating agencies Moodys is confident about South Australia that they'll reach their target of net operating surplus by financial year 2024, it flags the potential risks, including persistently high inflation, uncertain monetary policy, and glooming global economic factors. The South Australian Treasurer took a strong stance against the attempt by the Queensland government to retain a large portion of the GST during the mining boom, part of which has been revised in the GST agreement made by former Morrison government with the West Australian government. This arrangement considered each state's capacity to generate revenue from state taxes, mining royalties, and payroll taxes. Now, the Treasurer insists that the GST arrangement is biased in favour of Western Australia, which is a significant $5.6 billion boost in its largest budget. And if you do find value in this video, please consider hitting that subscribe button, as it does really help out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. Now, the state is dealing with an economic challenge similar to the rest of the nation, including rising inflation, national home mortgages increasing in rates, and the cost of living growing exponentially. The government remains steadfast in the decision to provide no broad-based cost of living relief for average households. Instead, it prefers to support those who need it most. Approximately half of South Australian households will benefit from an energy package relief announced earlier in the year. The South Australian Premier emphasises the importance of housing security in maintaining economic stability, reinforcing the decision to make households a focus point in their budget. As the Australian real estate market becomes increasingly challenging, mortgage lenders are adopting innovative strategies to make it more attractive for refinances. This change comes off the backdrop of interest rates rising at the fastest rate we've seen in a very long time, which saw the official cash rate hit a peak so far in June this year of 4.1%. This hike marks the 12th rate rise since May of 2022, pushing up monthly repayments for the average mortgage holder of $1 million home by $2,269 when they started on an average variable rate of 2.86%. From an average homeowner in Australia, the ongoing financial burden is severe, with the average discounted variable rate sitting around 6.5%. With a rising cost of living, many are finding it tough to keep up with their mortgage repayments. The Australian Prudential Regulator, APRA, established 3 percentage point serviceability buffer to prevent borrowers from entering into risky loans. So they had a buffer when they ask lenders to assess their loan applications of adding 3%. However, this has resulted in difficulties for borrowers trying to access lower interest rates. Even if they qualify for a lower rate with another lender, they're assessed on their affordability to handle the extra 3 percentage points on the current rate, causing potential refinances to remain stuck with their current lenders with higher rates. In response to this issue, we've seen lenders like Westpac reduce their serviceability buffer requirements by 2%. Additionally, Westpac and its subsidiaries have modified their serviceability assessment for some refinances, relaxing the strict 3 percentage point buffer on their serviceability. Now, the modified assessment that we've seen with someone like Westpac allows potential refinances to qualify so long as they can meet the 1 percentage point buffer on top of the current repayments, show a clean repayment history, and hold a credit score of 650 or higher. Separately, we've seen some lenders, including Macquarie, Bankwest, Bank of Queensland, and UBank, have started allowing certain workers who frequently earn overtime to count 100% of that, and as well as other allowance in their home loan application. These changes are aimed at encouraging more customers to switch lenders, especially those that have a proven reliability by regularly meeting their monthly repayments. However, it's not all good news. Even with those that have revised serviceability buffers, there are borrowers that are still struggling to meet their repayments that might not benefit. Some experts anticipate that there could be lenders that may hold back on adopting similar measures until it's certain that the RBA has concluded their rate hike cycle. Even with lenders that do imply these new policies, they'll likely benefit from borrowers who are maintaining their repayments and can demonstrate financial stability. Borrowers who are really struggling may need to consider other options. The first step is to check if your lender will offer you a lower rate, and particularly if they have lower rates advertised on their website, it's worth giving them a call and seeing if they match that. Another option is to explore the bank's hardship policy. While these strategies can provide some immediate relief, it's essential to consider the long-term impact that may lead to increased interest repayments over time, and thus it's critical for borrowers to do their own calculations and weigh up the potential benefits and drawbacks of switching from a different lender or taking up a new strategy offered by your existing lender. Last year, CoreLogic highlighted unprecedented numbers of household and unit markets at a neighborhood level with a median value of $1 million or higher. However, following 12 interest rate increases, the $1 Million Club has tightened its requirements, with a large number of last year's entrances now sitting below the benchmark. From April of 2022 to February of 2023, CoreLogic's National Home Value Index experienced a record drop, decreasing by 9.1% in 10 months alone. Despite a 2.3% national recovery in dwelling values in the last 3 months, this is still a 6.9% reduction from its peak. By May of this year, 22% of the 4,400 households and unit markets studied nationally sustained a median value of $1 million or more. This is a reduction from last year's 28%. CoreLogic's Caitlin Izzy confirmed that 237 household markets and 19 unit markets have experienced a median value that slipped below the $1 million in the past year. Burns Beach, a coastal suburb in Perth, emerged as a single newcomer. Sydney saw the most significant number of household suburbs dip below the $1 million mark, with 78 housing and unit markets recording a decrease in value. Sydney's large peak to trough drop valued by 13.8%, underlining this trend. Despite the reduction in the numbers of $1 million listings in Australia, 1 in 4 properties still sold for $1 million or more in March, suggesting the high-end buyers market still remains active in the market. Future performance in $1 million suburbs will be influenced by the cash rate. Historically, rising cash rates have depressed market values, and with many predicting further rate increases might occur in June, a delay in some markets returning to the $1 Million Club is expected. And remember to like, share, and subscribe to stay informed with all things property and finance. So guys, what do you think? leave a comment below. Are you going to benefit from the changes in the New South Wales and South Australian government's first homeowners? We'd love to know. Here at Hunter Galloway, we're a mortgage broker and deal with people Australia-wide. So if you're a first homeowner looking to get in the market and living in Australia, we can help. Call us on 1300 088 065 or visit our website huntergalloway.com.au where you can fill in a contact form. We'd love to get in touch. Guys, as always, thanks for watching and we'll see you next time.